Hello everyone and welcome to this video. In this video we will continue our discussion and forecast the remaining items of the balance sheet, and now we have to talk about other current asset. Other current asset is an item which includes multiple other items within this. So generally this other current asset is kept constant. Keeping constant means whatever it was in the previous year we will keep it same in the future also. Now to show you what type of items are included in other current asset, let me take you to the annual report of the company. So here on your screen, this company name is Colgate Palmolive, and this is the consolidated balance sheet of it. And here you will see there is an item called other current assets. How much is the amount of other current asset? It is 456. So let's see what exactly is included into it. Look at this. Interest rate swap contracts included in other current assets. Foreign currency contracts, other current assets. Commodity contracts, other current assets. Marketable security is also included in other current asset. Now, marketable security is an item which we generally keep outside other current asset, and that item is separately forecasted. So if we make the model of this company, what we will do, we will bring marketable security out of other current asset and put it separately. So marketable security will remain 23, and whatever is the amount of other current asset, that will be reduced by 23. So total current assets will be same, but other current assets will be reduced by 23 because marketable security will be written outside other current asset and it will be forecasted separately. But other current asset will remain constant in the future. The reason is these type of items we cannot forecast because we do not have a solid logic behind that. Okay, so mark other current asset type of items will be kept constant. The next item is property, plant and equipment. This item we have already forecasted in the depreciation schedule. So click on this depreciation schedule, and this is ending property, plant and equipment net. The next is intangible. So previous year of intangible minus the amortization of this year. So this is the amortization of the year. The next is goodwill. Goodwill will remain constant in the future. Goodwill is the additional amount paid above the fair market value of the net assets acquired of the target company. So whenever a company acquires another company, so the company pays additional amount above the fair market value of net assets of the target company. So whatever premium, whatever surplus amount is given to the target company, that is called goodwill. So if a company has not acquired any other company, so there will be no goodwill in its balance sheet. Okay, so when a company will acquire any other company on a price above the fair value of net asset, that additional amount will be called goodwill. In this model, we are not talking about any acquisition, so goodwill will remain constant in the future also. Next is deferred tax. So deferred tax will remain constant. Just like other current asset, other long-term assets will also remain constant. Now select this and press Ctrl R. Deferred tax is created when you have different accounting treatment between financial reporting and tax reporting. So due to difference of accounting treatment between financial reporting and tax reporting, there will be a gap, there will be a difference between the tax reported in financial reporting and the tax reported in tax reporting. So the difference of tax between financial reporting and tax reporting will be called deferred tax. We are not thinking that way that we will be doing different accounting now for financial reporting and tax reporting. So whatever we are doing will remain same in both ways. So we are not talking about this deferred tax. Deferred tax will remain constant. Just like other current assets or other long-term assets, we have other current liabilities. So there are many items included in other current liabilities. We will keep this also constant. And to show this what is exactly included in other current liabilities, let me take you to the annual report of the company. Here is your balance sheet. And on the liability side, we have other accruals. These accruals are what? These are other current liabilities. So let me select this, copy this and paste it here. How much is the amount of other accruals or other current liability? It is 1917. Now let's see what is exactly included into it. Look at this. This is 1917, which is actually going to the balance sheet. So total other accruals includes these many items. Just have a look at these items. So all these items are included in other accruals. So accrued advertisement, accrued payroll, accrued taxes, restructuring accrual, pension accruals, lease liability and interest accrued, derivatives and other. There are so many items within this. So we do not have one specific way of forecasting all these items. So generally we keep these type of items constant in the balance sheet whenever we make the financial model. So this will remain constant in the future. Short-term debt and long-term debt will be forecasted in a separate schedule. The next item, deferred tax, will remain constant. The next item is post-retirement pension cost. This will also remain constant. Other long-term liabilities will remain constant. The next item is equity. First is preference stock. We think it will remain constant. Common stock, additional paid-in capital, retained earning and treasury stock. We will talk about in the next video. That's it for this video. I'll see you in the next video. Thanks for watching.